Welcome, everybody. This is Jeff Fowler with the Apartment Owners Association. It is great to have you with us today. And yeah, the title is Escape California. Some of you are looking to escape. Some of you need to stay. Some of you need to go. And only you can determine if that's you or not. Here we are. We're in second month of the year. And I don't know about you, but those New Year's resolutions are testing right now. And man, this morning getting that workout done, I had to kind of tone it down a little bit and just get it in. And sometimes with our goals, we just need to take little steps, and other times we need to get a little bit of a rest. But anyway, I hope you're keeping your goals in front of you the way that I am, and I'm really wishing you great real estate success. AOA, we've been around for over 40 years. And our goal is to have the most successful group of real estate investors in the state. And there are several different ways to get there, lots of information that you need. And some of you are scaling up, some of you are winding down. And anyway, so no matter where you're at, we want to be able to support you in that. It was great to beat Prop 33. Yesterday, we had the city council meeting here in Los Angeles, and they voted down the proposed rent increase freeze. So we're celebrating that as a win for sure. And I just want to commend all of you. Last week, a bunch of you all showed up at the city council meeting. That made a huge difference. And I think it made all the difference, just the number of people. We had so many people there that you couldn't even get in, and so we maybe need to organize and create little pods to be at those meetings. But at any rate, it was successful. So thankful for you all. We've had a lot of in-person meetings in January. There is the legislative update that is on our YouTube page, and so you could check that one out if you haven't already. And you may have already seen the article in the magazine talking about rent reporting. And just for everyone to understand, rent reporting is not done through the AOA membership. It's done through the property management software company that we have called Property Manager Cloud. And renters pay $1 to have their rent reported. And so that's something that can be done. We have an addendum for that, and it's literally in the final phase. We have existing ones that are going to be updated. Literally, that's in the final phase, and by the end of the week, those will probably be updated on the website. But just, the deadline for that really is April 1st when the offer needs to be put in. And so you'll need to offer that if you have 15 units or more, or if you have multiple properties and you're set up as a corporation or as an LLC with a corporation. And so it's maybe not so common, but those are the requirements. So some of you, we don't want you to get caught by surprise on that. But anyway, that's what's going on. Dennis Block spoke a couple weeks ago. We have him coming up on February 25th, talking about security deposits, for just tips for housing providers, how to work with that at a state level. We have a few in-person things coming up. Buena Park on the 18th, we have an eviction and just cause evictions, like kind of the process of how all that works. And so that's going to be in Buena Park. There's a doubleheader. That is a doubleheader, so book that one because we did not book it in every location. February 19th, we have the Bay Area Landlording Power Conference. We've over doubled the number of vendors that we had there last year. We have a bigger room. We already have over 500 people signed up for that. So if you're going to attend that, definitely sign up. And there's just a few of those boxed lunches left. So if you're going to do that, definitely order that now because they're almost gone. And you do have to scroll down when you're getting tickets on Eventbrite. You have to scroll a little bit to see the add-on to do that. But anyway, so that's there. And then San Diego on November 26th, we have a doubleheader, and it will be Franco Simone and Company, attorney Franco Simone, talking about tenant screening, I believe. and just new requirements. So that'll be a great time down in San Diego. So yeah, lots of different stuff going on. And if you're new to AOA, I want to welcome you. There's a member orientation video on YouTube that you can check out. Just type in membership and you'll see a few different videos come up, and just watch any of those to learn more how you can utilize the resources that we have that you're paying for. It's all, at this point, you paid for it, so much of it is free for you. So definitely want to invite you to maximize your membership for sure. And anyway, so our sponsor today is H&S Wealth. They focus on 1031 exchange investments for their clients, as well as traditional wealth management. So they do all of it, but really they're focusing in on the 1031 exchange investments. And so thankful for them. They've been working with AOA members for over 20 years, and so real thankful for them to make this live stream possible. And our speaker today is an AOA, is a Los Angeles local. He's a real estate and securities professional since 2004, so he's been in this thing for over 20 years now. He's a partner to Bob Horning at H&S Wealth, and so we're going to bring up Adam Bryant for you.
Thank you. Thanks, Jeff. Wonderful introduction. Again, as you heard, my name's Adam, and Adam Bryan with H&S. I am licensed as a securities professional as well as real estate, although I'm inactive. I have been doing this over 20 years, and I have focused in my career primarily on 1031 exchanges and replacement properties, DSTs. I wanted to talk today, I talk to members quite frequently, and I hear a lot about maybe I should get out of California for a myriad reasons. And I wanted to talk about perhaps some of the pluses and minuses of being a real estate investment property owner in California, northern and southern, and the benefits and advantages of leaving and moving out, as well as the disadvantages. And then if you leave, if you sell your property and do a 1031 exchange, what are you going to do? Are you going to stay here? Or are you going to move on? I've been involved in literally over my career around 200 million in investor equity placed directly and about 500 million indirectly where I had teams. So I've been doing this for a long time and quite a bit of experience, hundreds of clients. I'm also a Californian. I've lived here, I'm just turned 60, and I've lived here my entire life. Orange County, Long Beach, West LA, and the Valley, both Southern and Northern Valley. So interestingly, I've been about 2 miles from the 405 freeway my entire life, and liked them all. All of them had benefits. Why are we here? Well, of course, some of us are born here, like myself. Many of us, our parents moved here perhaps in the 50s or 40s after the war, when the LA started to boom and Northern California started to grow. And the Bay Area, of course, has always been strong. Why? Well, first, we all know, of course, we have wonderful weather. That goes without saying. Beautiful beaches, very different cultures and different types of food. We have entertainment. So those are all the sort of obvious reasons that we're here. But there's some things I wanted us to think about on a positive note about owning and living in Southern California and Northern California. I'll use some examples. For one thing, we're the largest state in the country. I'm not sure everyone knows that. 39 million residents. And that means that there's constant demand for apartments, among other things. What else? We have tremendous appreciation. Why? A large part in the more metropolitan areas, the Bay Area, Sacramento, San Diego, Los Angeles, is that they are infill. Infill is a real estate term that essentially means it's full. To build something, competing product or additional product, apartments, you have to knock something down. It's very expensive, it's very difficult. That's why cities that are very old, like New York and Chicago and London, build up, meaning, of course, that they literally have skyscrapers. But as we know, LA is very different. There's been a little bit of that in downtown LA. But for the most part, if you own something virtually anywhere in a metropolitan area of California, you're in an infill location, which insulates you from competing properties that are going to make it tougher for you to increase rents. well, that makes that property you own more valuable. And in other parts of the country, I'm sure many of you have been, certainly to Las Vegas and Phoenix and St. Louis, etc. Even in the big cities, very close are areas where the city expands, what they call the path of growth, where they can build competing product, which makes your product, even if you're close to the center, perhaps less valuable. But that doesn't happen so much in LA. So that's a good reason. Another reason is our appreciation. What we've seen, I ran a few numbers, going back around 30 years, 1991 to 2022, the average appreciation, this is for single-family homes, but it extends to apartments and multifamily, average annual appreciation was 8.62%. Really good. If you look at the stock market, you're usually around 8 to 10%, and we've kept up, plus the tax benefits of investment real estate. So that's a pretty good average. But more recent years, between 2018 and 2023, the average annualized has been 9.2%. Again, very strong returns. And that's as a result of all the things we talked about, all the reasons that we're already here, the weather and the infill locations, etc. Worst year, just as a reminder, the real estate, of course, goes up and down, although it tends to track up, like these averages show us. Worst year was 2008. Property values dropped on average 37.09%. Ouch. I was shocked when I saw that number. I would have guessed around 30. But we did have pretty dramatic loss of value, of course, during the debt markets and the foreclosures and the short sales and so forth. We rebounded fairly quickly and, in fact, had our best year just 4 years ago in 2021. This is in recent years since the 1990s. Average appreciation in 2021 was 25.03%. Pretty phenomenal appreciation. If you recall, that's when interest rates were dropped because of COVID and inflation, and values dramatically appreciated. To get back to normal would be, let's say, last year, 2024, we saw an average of around 5.6% appreciation in the year 2024. Even a tough year, a lot of uncertainty, pre-election, all the things in inflation that were happening, we still appreciated 5.6%, which is wonderful. So it's a good reason to be in Southern California, Northern California, Central California. California has those advantages, and I want to remind you that there are some good things about being here. Another thing is that most folks that have debt or a mortgage on their property, on average these days, are around 3 or 4% interest rates, and that's because they were locked in when interest rates dropped in 2020, 2021. Right now, if you were to go out and get another mortgage, you'd be at around 6 to 7%. And that's generous. It could even be, it's been above 7 briefly. So the problem is if you do a 1031 exchange, you have to replace the total value with equal or greater. So you sell a property, $1 million property, with a $500,000 loan. You've got that $500,000 in equity, but you need to reinvest it and still buy something for $1 million or greater. So what happens to the loan? Well, when you sell the property, obviously the loan is paid off, and you now must either add $500,000 out of pocket, which most people don't want to do or can't do, or get another loan. And that's the most typical 1031 exchange method, to get a loan of equal or greater value. When you do that, though, you're going to have a mortgage that's literally going to double. So that would be an argument, and that's actually a challenge for real estate buyers right now because so many folks are not selling, creating a scarcity in the market. But it's also keeping prices up. That's why we've continued to see appreciation even when interest rates have risen in recent years. So these are all good, positive reasons to be here. It's why we're here. Personally, as I mentioned, I've lived here all my life. I live in California, because you can go skiing in the snow in the morning and watch the sunrise, and go surfing in the afternoon and evening and watch the sun set over the ocean. That's why I live in California. I should mention, I have never done that in 60 years, nor have I ever skied. I did go surfing once, and I hated it. But that is the reason that I live in Southern California. Of course, I'm talking about the options and the diversity and the variety and all the positives that I've discussed. So these are reasons to stay or to understand why you're here and kind of, maybe pat yourself on the back a little. You've been doing pretty well, even with all these challenges. But let's talk about them, especially as we get older. We've owned our real estate for many years. it just feels like landlords are constantly, the punching bags, whether it's in Sacramento or in downtown LA at the city hall. Why would you leave? Well, I can't not mention the fires of late. Growing up here, I know Jeff had the same experience. Fires were out in the mountains or in the forest or in the hillsides. They were never really I never felt threatened. I might have inhaled a little bit of smoke. But what we've learned is that we've encroached so far into these areas that Altadena now had major metropolitan type city streets that were affected, as well as homes, apartments, and obviously the Palisades and very nice homes there in Malibu. It's a challenge. It's a real problem, and there's nothing that's going to stop it from continuing. There's a lot of talk now about how to retrofit and protect your property. But it's a challenge that we didn't have 20 years ago that we have now, and we have to remember it's going to continue. Not to be super downer here, but also earthquakes. We forget, we get very complacent about, we haven't had a major earthquake really since 1994. And that seems to me like a very long time. It probably does to you. But you have to remember, for us, for a human, 100 years is a long time. When we learn about somebody living 100, we're impressed. But when you look at it from the way tectonic plates move and the potential for earthquakes, which we know will occur and do, 100 years is nothing. It's a fraction of a second. So my point being, we will have another one. Obviously, you do what you can to prepare. You can't live your life worried about it, but it's a consideration if you're thinking of staying in this state, because we are on what's called the Ring of Fire. And not to get into a geological conversation, but it's a real estate risk. Many of us don't have earthquake insurance. If we do, the deductibles are incredibly high, 20% plus of the value of your property before you get a dime from the insurer. So it's something to factor in there. And again, I think people forget about it. Same thing with COVID. We went through this horrific thing nationwide, not just Southern California or Northern California, but everywhere. That type of thing is very likely to happen again. That's what we're told. And we'll try to protect ourselves and do what we can, but it's another consideration wherever you are. Assembly Bill AB 1482 was enacted last year, which means that essentially you can increase rents 5% plus the local CPI, Consumer Price Index, and a maximum of 10%. So the state has now told you what you can do, and regardless of what the market is paying or charging tenants, that's already in place. I believe in parts of Los Angeles, it's around a 3.9% CPI, and plus the 5, you can charge as much as 8.9% increase in rent, maximum. And so that's a challenge you will not see in most other states. A little bit in New York, but really it's unique to Southern California, and Northern California is also going through these same kinds of things. This is a Los Angeles issue. Prop 33 was defeated. Jeff's team and all of you members did a great job. That's, if you recall, to get rid of Costa-Hawkins, which would enable local cities, counties, municipalities to create their own rent control. But they will try again. Prop 33 was not the first attempt. I believe it was second or third in recent years. And that's going to, again, be something to look forward to, and hopefully will continue to prevail. RSO, Rent Stabilization Ordinance, some LA properties that are older than, I guess it's October 78, 1978 construction, you can only increase the rents 4%, 5% if you pay for utilities. But that's your maximum, that's a requirement. Security deposits are limited to a month or 2 months if you only own 4 units or less. This is a Southern California thing. If you decide to move back into your property and you remove the tenant because you have certain circumstances with your personal residence and it becomes your personal residence, you cannot then, for a year, even if you move out, rent the property again. That's prohibited. So there are many challenges being a California landlord. I don't need to tell you that. If you remodel, it didn't used to be that was a genuine reason and you're going to have the tenant move out, remodel, and improve the property. Well, now you have to show all the plans to the tenant and make them available to prove it. Never a requirement before. You cannot discriminate based on credit rating if the tenant is receiving government assistance. That was outlawed as well. And lastly, the other fun little factoid I have, your tenant application fee, it's still capped, I believe, at $62.02. Even if you're paying more for all of your review, I hope you're not, but you're not allowed to charge that to the tenant. That's the maximum you can charge. Nationwide, we have an issue with inflation. We all know that. We've seen it stabilize, but prices have not come down, and we're not so sure that it's going to stay stable. Right now, the U.S. average inflation rate is 2.9%. The government will tell you, economists will tell you, 2% is reasonable, healthy for an economy. Anything above that could be problematic. California, the entire state, the average, the inflation rate rather, currently is 3.4%. So we're much higher than the rest of the nation. You know, the positive here is that you're able to charge more rent, and that comes with inflation. Inflation's largely energy and housing, whether it's interest rate for a home loan or rent for a tenant. So there is the positive that you're able to increase rents. The negative, of course, is everything else costs a lot more money. The HVAC guy who's coming in and doing repairs, all the equipment, everything involved in your property and the expenses has risen dramatically, and again, even higher in California. We have the highest taxes in the nation. A lot of people don't quite realize that, but we're number one, I always like to say. 13.3% with a potential surcharge is the maximum tax rate. And then, of course, you've got 36 to 37% for the federal government. So we have incredibly high taxes here. Some states, as we know, Nevada nearby and Texas have no state income tax. Insurance, and this is tied to the issue with the fire. Prior to these fires, we already were seeing pretty dramatic increases in premiums. You've all felt it. Some folks were even leaving the state. Tokyo Marine, Trans-Pacific, Allstate, State Farm were canceling policies or not renewing policies and increasing their premiums. Well, that's in the last few years. In the last few weeks, here we've seen in State Farm, for those folks that are in certain areas, they have just requested a 22% increase to the State Insurance Board for premiums, and it'll likely be approved. So whether it's problems here locally or even on the East Coast or in the South with hurricanes, insurance companies have reinsurance. It affects everyone, in other words. But it's worse in areas like Southern California, Northern California, where we've had major fires. All of these are tough issues with living, working, and owning real estate here in California. So what do? Well, you can sell your property and stay here if you just prefer to live here, and pay about roughly a third of your taxable gain will go away. Literally between state and federal capital gains taxes, depreciation recapture, Medicare surcharge. Most folks, if you walk away with, say, $1 million when you sell your property, about $330,000 will go to state and federal. That's a pretty common average. Some folks a little higher, some folks a little lower. And then you can leave the state and live somewhere else and not own investment real estate, or you can stay. But you're going to lose that money, and it'll, I can tell you, be a very tough job of replacing that equity that you lost in the taxes, even over time, because now you're starting with, 66% of the money. It's much tougher to even just get to break even. So what else can you do? Well, you can sell and do a 1031 exchange and go out of state. That's an option, and some folks do that, and some folks will stay. So, yeah, there we go. There's a third option. Oh, I'm not in control. There we go. There is a third option. You can leave it there, thanks. And that is the Delaware Statutory Trust, or DST. So now we've talked about whether we're going to stay here or not, or sell or not. Is there a right answer? Folks out there, raise your hands to your computer screen or whatever you're looking at me on and say you think it's a good time to sell based on everything I just said. Now, folks that don't think it's a good time to sell and all those positives about California, you're going to stay. You raise your hands. I like to imagine you're all raising your hands. Well, I can tell you that you're all right and you're all wrong. And by that I mean there is no correct answer. There's an issue of where we are in a market cycle, and that's really what you're probably thinking about between regulatory issues, taxation, and appreciation, valuation. There's good and bad. But I always remind folks that it's a personal decision, a very important personal decision. And sometimes folks forget to put that forward. You know, maybe it's not a great time in the market to sell, but you really are tired of dealing with your tenants and all these regulations. Maybe you want to spend more time with grandkids and golfing handicaps. That's okay. My job is not to convince you one way or the other. I talk about getting out of California because a lot of members that I talk to, landlords, really want to. But I also talked, as you recall, about some positives about living here as well. Ultimately, it's a decision that you make, and it's a personal decision, and I can only help you to some degree with that. But if you decide to sell, and if you decide to do a 1031 exchange and defer those taxes, and you want to be out of state, but you don't want to manage property out of state, which is very difficult, or move, there is a third option, and not a lot of folks know about it. In 2004, the IRS issued a revenue ruling that said we can take this legal structure of ownership and treat up to 499 investors as owning real estate, just like they bought their own real estate, in the form of what's called a Delaware Statutory Trust, or DST. So let me talk a little bit about what a DST is, how it works, and it may or may not be right for you. I'll give you again the positives, if you will, and the negatives. What are they? Well, first of all, they're going to be 50, maybe as small as 25, 30 million to 100, even portfolios of 200 million in valuation of real estate. As you see here on the screen, an Amazon warehouse that's several football fields or more, built for distribution. Certainly multifamily apartments, which is one of my favorite asset classes, hundreds of units. Self-storage is another asset class I'm rather fond of. They can be anything. They can be office, retail, etc. I focus on certain types of property, and we'll talk about that. But the point is they're very large. They're frankly the kind of asset none of us most likely can afford to own on our own. But you're able to own a portion of it, and the IRS will treat it as the equivalent of just owning your own 4 units in Wilmington or whatever. For tax purposes, for 1031 purposes, everything is the same as what you're doing now. A lot of folks have trouble with that concept because it's so different. But in fact, you file a Schedule E with each of your properties on your tax return, or your accountant does. You will do the same thing, but with your DST ownership positions if you own a fractional interest in one of these DSTs. Oh, there we go. So what is it and how does it work? Well, first of all, let's start with the sponsor. Sponsors, it's an investment company, it's a real estate company, it's a management company. They're the real estate player. I'm an advisor. I can work with a number of sponsor companies, but the actual DST investment starts with the sponsor. And that sponsor scours the country, which is no simple feat, to try to find a good quality real estate to eventually turn into an investment opportunity. They acquire the property with their own capital. If there's a loan, and there is usually pretty conservative leverage, they arrange for the loan, and everything is done in the name of a single newly created entity, the DST. In other words, each property that's acquired, or a portfolio of properties, is in a newly created DST, which only has the purpose of owning that property explicitly. So that's very important. You're not in what's called a REIT, or a real estate investment trust, where there's a lot of different properties in there. That's owning stock in a company that owns real estate, and they pass through benefits to the investors. That's what a REIT is. DSTs are different. They're just a form of owning the real estate and then essentially divvying out shares to different co-owners who own their own fractional portion. It can be any kind of investment real estate. Can be anywhere in the country, and there are many, many options out there. I talked about earlier, and I'll mention again, I've avoided, probably wisely, retail, office, student housing, which a lot of folks do like, senior housing, which is deceptively risky in my opinion. We've focused in our practice on Class A, higher end, newer multifamily apartments and self-storage, almost exclusively, not quite. And why do we do that? They've held up the best, in our opinion, that they're going to insulate you from downside risk, recession, et cetera. And that's been proven time and again, certainly during the Great Recession in '08 and even in 2020 with COVID. These asset classes tended to keep their operating income the same or even improved, which is pretty impressive. So the sponsor creates this new entity. It's a legal entity. They acquire the property in the name of the entity. So right now, in this example, the sponsor is 100% owner of the DST, right? They created the entity. They're the only one in the game. They've put their money into it. Now what they'll do is sell off individual interests. By the way, with leverage, I forgot to mention, back in the bad old days in the early mid-2000s, the banks were obviously far too generous, as we know. And even in these institutional properties, we were seeing 65 to 80+% leverage loan to value. Far too high, very risky, and we all paid the price. Nowadays, I would argue it's too low. We have to put so much equity in the property. We're only getting 30 to 50% loan to value. Very rare that we're not putting about 50% down. Now that makes the investment safer because the property would have to lose 50% in value to be upside down, right? But it also means you have to bring in a lot of capital initially, and that's tough. Well, the loan's in the name of the DST. Again, if there's a guarantor or signator required, of course, the sponsor at this point is going to handle that, and that's going to put the loan in place permanently, usually a 10-year term. They then go, the sponsor, and sell off interests. Beneficial membership interests is the technical term, to typically 1031 exchange investors. And the reason that's so common is because it was designed for 1031 exchangers. You could just put money into a DST without having been completing an exchange, and it does occur, but the most common are exchangers. 100% of your percentage ownership, let's do simple math, if you own 1% of the DST, that means you invested 1% of the equity raise. $50 million, you put up $500,000. You get 1% of the loan. Remember, we talked about having to replace the debt. Interest rates are a little bit lower for these large institutional properties, but the point is you won't be underwritten, you won't have an application, you won't sign on a dotted line because you're not on the loan. The DST is, and it passes through to you your share of the debt. So that works for 1031 purposes, very important. For depreciation purposes, because you're actually going to own, in my example, twice as much real estate. And for all the depreciation and benefits that you get from leverage, interest deduction, and so forth. All of this is going to be factored in, and the sponsor is responsible now as the trustee of the trust for overseeing managing the property, or hiring the manager and overseeing them, acting as asset manager or both. And they're generally throwing off about a net of 4 to 6% cash on cash, net cash on cash, after all these expenses and before you take your tax deductions, so that you're sheltering a lot of that. On $1 million investment, that's $40,000, $50,000, $60,000 would be the most I've seen in recent years, cash flow in the beginning of the investment. So that's what your net is. When you look at your own net at home, people tend to just multiply what their gross rent is, and they figure that's what they're, they divide it by the value. You've got to remember all the expenses, the insurance premiums, the taxes and so forth, and upkeep to really get to your net operating income, and then you would divide it by the equity that you have in the property to get a sense of what your return is. Most people in LA, because our values are so high, we're looking at 2 to 3%. So this actually in many cases outperforms, and that's because these are in different markets. They're not in San Francisco or Los Angeles or New York. They're not in primary markets, but they're in good, strong secondary markets, cities like Orlando and Nashville, Washington, D.C. I mentioned you can have 499 investors in a DST. The IRS allows that, but you're not in partnership with 498 people. First of all, usually it's only 100 or 200 to raise all the capital, and the DST is sold out. The reason I mention it, however, is that it means the sponsor can make a very low minimum investment to get into one of these. The reason that's important is if you have, let's say, $600,000 in net equity, you can invest in as little as $100,000 in 6 different properties, or more typically maybe 2 different properties with $300,000 or 3 with 2. The point is you're able to diversify your investment in a way that you can't do when you have only $600,000. Certainly in Southern California, maybe you own a house or you own a duplex somewhere. So that's 2 units. You lose a tenant and your 50% NOI is reduced. When you own a DST with 3 properties, let's say, you may have around 1,200 tenants. Meaning, of course, that if you lose a tenant, it's a Tuesday. It doesn't matter. In fact, it gives you an opportunity, if the property is managed well, to increase the valuation. So that is a huge advantage for a lot of DST investors. They like that they're in multiple states, perhaps, with multiple different sponsors. We work with you to figure out that right balance, make sure you're acquiring the right amount of real estate to cover your 1031. The sponsor takes care of everything. My favorite line, I've been doing this a while, and I continue to say it, it's the best thing and the worst thing about a DST. Because what's the catch, right? People want to know, where's the downside to this? Well, there is somewhat of a downside, depending on your perspective, and that is you don't control the investment. You're truly a passive investor. You're relying on these sponsor companies, and obviously you want to pick the right ones, to take care of your investment, your equity, your real estate. That's, many people are not comfortable. They're not there yet, or they'll never be there. They want to make that decision themselves or have their kids make it as they age. It could also be the best thing because you're never going to get a phone call from a tenant with a stuffed or clogged toilet. You're never going to have to deal with an eviction and stand there with the sheriff. You're not tenting the property and having the termites removed. I don't need to tell you all the horror stories and difficulties that come with owning residential real estate. Well, all of that is going to be managed by the sponsor. They're going to take care of everything. They are going to send you distribution. I was going to say a check, but it's usually direct deposit of your net cash flow at the end of each month. It's monthly distributions. And at the end of the year, you'll get a tax package that you're going to use or give to your CPA that contains all the depreciation potential, all the expenses that you paid, so you're able to file it on your Schedule E. All of this is what we like to call armchair income, meaning it's completely passive, and that could be a good thing for you. You could be tired of all these difficulties. But again, if you don't want someone else taking care of it or you're not comfortable with that, then one would argue that that's a disadvantage of a DST. You're giving up control. You can exchange in and out of a 1031 just like any other real estate. Typically, it's a 6 to 8 year hold. In recent years, it's even been a little shorter. That's because we've seen such dramatic appreciation since 2020. I think moving forward, if you invested in a DST today, nobody knows, but probably it's going to make financial sense to sell, hopefully with a nice profit and return, about 6 to 8 years later, usually less than 10 years, almost always. Big question, it may be on our Q&A, and by the way, you can enter questions now into your Facebook and YouTube and all the stuff that I don't understand. But I know that you can put in some questions. I know I've covered a lot of information, but I'll just tell you quickly because it's one of the most common ones, liquidity. How do I get out, Adam? Well, really, you should think in terms of you're in it and you're going to hold this property for 6 or 8 years, the sponsor is, and they're going to take care of it, and then they're going to make the decision to sell when they believe market conditions are right and they're providing the best return for their investors. Can you sell it earlier? You can technically, yes, but I can't tell you there's a secondary market for DST interests. Generally what happens is there's an offer made to all your fellow co-owners in the same DST that someone wants to sell all or a portion of their interest, and that can be handled internally. And when and if you find that buyer, because remember all the other folks were doing exchanges, they're all accredited. I should mention you have to be an accredited investor to do these DSTs. It means you have $1 million net worth or greater exclusive of your home. Well, typically when people have gotten out or sold a portion of their DST interest, they've sold it to a co-owner who's in the same property. And if it's a good performing property, many of them will choose to do that. If they don't, it may be tough to sell your interest, and you may need to wait until everything, the whole property sells. We got to remember a couple of things. The sponsor matters. You want folks who've done this full cycle. They've gone through, they've bought the property, managed the property, sold the property. Extremely important. I talked about the benefits of multifamily and self-storage. They've held up the best. There's always a need to sleep somewhere. People have stuff. About 1 in 10 households in the United States has a storage unit. And then some other nice things about self-storage that people forget, like small businesses use them extensively. About 15% of the units are occupied by small businesses that don't need a warehouse. There's about 1 million US service members that are often relocated. They put their stuff in storage. Death, divorce, etc. So there's a real demand, and it's growing. There's 3 rules we all learned about real estate when we started investing: location, location, and whatever the third one is. And that's, of course, important. If you're investing in a DST, but it's kind of in the middle of nowhere, that should be a cause for concern. You want to be in a strong market. It's probably going to be a secondary market, meaning it's not a primary like a New York or California, Los Angeles rather. But there are markets that are very strong and that are growing, which is what you want to see. Population growth, job growth. Very important to owning particularly multifamily real estate and self-storage. And of course, the income of the tenants and the income of the folks in the local area and the value of the real estate. You want to be in good areas with people that have strong credit and good earnings histories for all the obvious reasons. Okay. So like I said, you've got the opportunity to ask me some questions. We like live questions, so please bring them on. If you'd like a free consultation, just talk to me individually. You've got my email, you've got my phone number. Reach out to me. There's no hard sell. If it makes sense for you, great. I'll tell you how it works. I'll answer your questions. And when the time comes, I can help you find the right DSTs for you. I can also send you some examples once we talk. With that, I'm going to hand it back over to Jeff. I think I've exceeded my time a little bit, but we do have time for Q&A.
All right, thank you so much. Yeah, if you're watching from the AOIUSA.com, there's a blue help button at the bottom, and you can put your question in there, and we can get to it. And I was a little surprised. Do you think, I kind of think local prices on real estate have gone down. What have you been seeing?
Yeah, in recent months, that was for the full year for last year. It did increase. And the reason is that there are just so few properties. We did start to see some decline compared to 2023. If you recall, 2021, we had 37% appreciation. But yeah, when you look at the full year, for the whole Los Angeles area, I used Los Angeles, there was still appreciation, and I attribute that to interest rates did start to come down a little bit. Prices stabilized a little, but the real challenge is we don't have enough what we call transactional volume. There aren't enough properties being bought and sold for buyers and sellers to kind of come to reality on what prices should be, what the value should be. Remember, there's no inherent value to anything. It's what a buyer is willing to pay and a seller is willing to sell. But when you have so few transactions, you'll have an outlier that'll bring the average down, or in your neighborhood, a property that sold actually happened to me that was much lower than it should have been. But when you look at the average, we still saw nationwide and in Southern California appreciation in 2024.
Great. And you're talking, is this all residential property or specifically?
Yeah, I mentioned it's single-family residence, but it's reflective of multifamily as well. You might have seen a little cap rate appreciation again in some areas, meaning values of some apartments went down a little bit. But generally, they've held. Real estate's been doing quite well, and the stock market, of course, is a big gamble, but it's been in kind with that as far as appreciation and value.
Yeah, I think, we've seen things that were listed get reduced and reduced and reduced again.
Sure, there's always the outlier,
on the multifamily. But here we go. We do have a question from Joe. Can you comment on establishing a corporate entity to own your real estate versus direct ownership, i.e. an LLC?
Yeah, sure. So a lot of attorneys, I'm not an attorney, I can't give legal advice, but they'll recommend creating a limited liability company, which essentially means that if someone were to sue a slip and a fall or a tenant fire or what have you, they can only sue for the assets of that LLC. And if you put each of your properties in a separate one, that means at worst they can take your property, God forbid, but they can't go after your other assets. Is that advisable? Well, sometimes it is and sometimes it isn't. I should mention a DST gives you that same protection. You're not at risk beyond the equity that you have in the DST ownership position. But the question was commenting on it. I guess I'd say talk to your attorney, look at your circumstances, your finances, everybody's a little different. Many folks, I will say, will create an LLC or even a corporation which has a separate tax ID. That's an issue too. But having a pass-through LLC is very common for smaller investment properties.
Right. If you think of it this way, if all your money's in your wallet and someone picks your pocket, you lose all of it. If you take a few bucks out of there and stick it into your front pocket, then you lose less of it. So
I love that analogy. I'm going to use that. I haven't heard that one before. Yeah. Exactly. Your LLC is what's in the wallet, and that's it.
So when you're sued, what you own is what they can take. So the less you own and the way that you're able to move things around a little bit, then that's helpful for sure. And we have definitely at the Bay Area Landlording Power Conference, we have a speaker talking about how to protect assets. We have that up at the trade show. That'll happen in April. So you'll want to go to that. We actually have a couple speakers talking on that topic. And there's a guy local, Ali Talai, that is great, and we may have some other ones there. So there's definitely, it's something you want to look into. You really want to understand how all that works, asset protection and just all that's required from you. But understanding it well takes some research, takes some time, but it's well worth the time. And do it while you're feeling good instead of when you're on your deathbed.
That's a good point.
Or when you've already having a lawsuit. So.
One question I get a lot, and again, feel free to chime in if you have other questions, but let me address it, and that is fee. People ask, aren't these really expensive to get into? Mm-hmm. I always remind folks you have to compare apples to apples because this is kind of confusing, but let me simplify it. If you sell real estate, of course, the National Association of Realtors just changed the rules on residential property, not on investment commercial, but essentially there's going to be let's call it a 6% plus or minus commission, closing costs, etc. when you sell that property, whether it's, now they're trying to make the buyer's agents contribute, have the buyer pay their agent versus the seller. But when you add it up, assuming you had a traditional 6% fee, maybe 1% extra or less for closing costs, that's the load, that's the costs that really aren't going into the real estate. They're going into all these fees and commissions. A DST is pretty similar. Depends on how much equity is being raised and how much debt there is, because things are based on the equity. But the long and the short of it is you're probably looking at about 8 or 9% instead of that 6 or 7. So there's about a point or two of additional fee or cost. Not tremendously more expensive, but a little more. And why is that? Well, I've talked about all the things the sponsor does and manages and takes care of and acquires the property. The broker-dealer level, that's not like a real estate agent, but they're vetting who these folks are, these sponsors, who I am as an advisor. A lot of review, a lot of due diligence goes into these investments, particularly because of what the lender requires too, aside from SEC. So you get a lot for that extra cost, but not dramatically more. When it filters down to me as an advisor, generally I'll end up with about 2.5%, 3%, very similar to what a real estate agent would earn. So fees are a little higher, but not dramatically higher.
Now, do you recommend when people are doing a Delaware statutory trust, are you recommending multifamily mainly, or do you recommend, what are you guys recommending these days? Yeah,
I've been pretty consistent really since the Great Recession. Prior to that, I had some experience in virtually every asset class, and I got a real education when we saw the debt markets seize up and valuations drop so dramatically. What we saw and what we've learned is that higher end Class A multifamily, we use the term Class A, some folks will tell you that means within 10 years of construction or 15 years. There's no real definition. But essentially luxury or nicer apartments, the most expensive in the town, they held up the best. Because if you think about it, in a recession or in a downturn caused by a pandemic, as we learned 4 or 5 years ago, the folks at the higher end of the income scale, they get affected. Everybody gets affected. But they're usually last and least, meaning, as an example, if you're a factory worker, you're a waitress, you're a hairstylist, you're going to feel that recession or that pandemic and that requirement to stay home much more dramatically. The folks that have the type of employment where they can work remotely, which has become very common, as we know, well, they weren't that affected financially, and in fact, the real estate valuations dramatically increased through the pandemic. In the recession, those folks again were impacted, but less. So what we're doing is we're focusing on, my biggest concern is capital retention, right? It's preservation of capital. I don't want my clients to lose money in their investment. I want them to make money. The next issue that's important is cash flow. Most folks want to see net cash flow, and these higher end apartments tend to throw off, as I mentioned right now, around 4, 5, 6% net cash on cash. And lastly, appreciation. I gave you those numbers for Southern California. Homes, very strong, very high. The DSTs have been appreciating nicely. They've been keeping up with the market. In recent years, we saw rather dramatic appreciation. In the Great Recession, some properties lost value, but the multifamily, the high-end apartments, at least retained their value. And the self-storage facilities, here's an interesting one, improved during the Great Recession. The only real estate asset class that, on average, net operating incomes increased. Why was that? Of course, so much more demand. So many people got a roommate, so they had 2 couches. One of the couches went in storage. We've continued to see that benefit from self-storage. It's also automation has made a big difference. It's much less expensive to manage one of these facilities. Some of them are managed virtually, meaning there's a machine like an ATM. You can rent units, cancel your lease, etc. Also, with self-storage, usually once you've gone 2 months, depends on the lease, but without payment, you're out of there. There are no rental protections. There are no things you have to worry about, like with tenants here in Southern California. It's very easy to evict a tenant, and that makes it a huge advantage. And they're just simpler to manage. So those are the asset classes we stick with. What do we avoid and why? Single tenant triple net is the most common that you're going to see. By that I mean usually retail, could be a company, a manufacturer, and they have a lease that's called triple net, NNN, net of taxes, insurance, and expenses for the property, meaning the tenant pays for all of that. And that kind of competes, if you will, with DSTs because it's also passive. The problem with triple net leases is they tend to be initially for a very long time, 15, 20-year leases. They have built in almost universally 2% bumps. Remember when we had inflation in the early years of the pandemic of 10%? 2% was the most that landlords were able to increase. Usually it's every 5 years, 10%. The problem with those is by the time they're filtered down to be available to you and me as an investor or even in a DST, those leases have aged. Maybe they have 10 years or less remaining on the lease. So you're investing in something that you may lose that tenant. And it may be a very big, expensive property that's very difficult to reconfigure. And that's not even addressing all the risks associated with retail these days. We're still seeing closures of major retailers, of course, because of online competition. Office, we all know that folks are able to work remotely. There's still debate about that and benefits and advantages and disadvantages. But I can tell you that office vacancies have been increasing dramatically since the early mid-2000s. Senior housing. A lot of folks like that because we all know we're all getting older. I've heard a statistic that there's 10,000 65-year-olds every day, and that's true. But what we forget is that many folks in America, they're relying on Medicare for their needs, and you cannot use senior housing or assisted living, as we call it, with Medicare or Medicaid dollars. Those are private pay properties. How do people afford that? And we're talking, on the low end, 60,000 to not uncommon 100, 120,000 a year to have, your folks, your grandparents in one of these facilities. Well, how is that paid for? Typically, it's paid for by the sale of the senior's primary residence. And that's important because when we have a housing downturn, as we did in 2008, suddenly homes have lost a lot of value or they're not even selling. Well, that meant that folks couldn't afford to move into those facilities. Unfortunately, you have a pretty steady stream of folks moving out of the facilities, and usually they're on a stretcher. Unfortunately, of course, folks pass away, but they're not replaced. Similar thing happened with student housing. A lot of remote students nowadays. Obviously, in the pandemic, there was a huge impact on both those asset classes. Fortunately, in our practice, we've stayed away from them literally since the early 2000s. We just want to put our clients in the same thing we would invest in with our own money.
Great. Thank you so much, Adam, for sharing. And any last comments before we?
I just want to
close it out?
thank you, Jeff, and thank the members for participating. You always remind me to remind folks, and I will, that I'll be at the trade show right off from the center, from the AOA booth, and you can come talk to me. I'll be giving a 20-minute power talk as well, and that's in April, I believe.
Yeah,
and,
April 16th, that's right.
And again, just feel comfortable reaching out to me if you want to talk about your situation and whether this makes sense for you, and I'm happy to give you some free consultation.
Great, so you see his number there, give him a call. And anyway, thank you, everyone. Thanks again for those of you that showed up at City Hall. And yeah, we'll just keep moving forward. Take care. Bye-bye.
Thanks.